All right. So welcome everyone, or welcome back. It's nice to be out here again introducing this panel. Just really quick from me, I wanted to give another plug to the Elijah Foundation. The very handsome boy right there on the right is my son. His name's Bradley. He goes to the school. That is him on the farm that Deb, if you listened earlier, mentioned. Sorry if you can't hear me. Elijah is part of the iCares program. It's a good thing that the iConnections team is doing. So I just wanted to encourage everyone while I was up here to take part. If in doubt, pick Elijah, although all the charities are great. Hi, Deb. I know Amanda's coming up soon on the Chick Mission. I'm a big fan of that one too, and a donor. But I just wanted to encourage people to take part while you can, and it's just a great cause. So credit to the iConnections team. For this panel, this is the macro panel with Jefferies and Schoenfeld. Dan Furstenberg, affectionately known as Firsty by those of us at Jefferies, will moderate. He's going to talk to Colin Lancaster, who's the global head of discretionary macro and fixed income at Schoenfeld. Firsty has been, or Dan, as some people call him, has been with Jefferies for 15 years. He's been in this business a lot longer than that. He's built an incredible career covering groups like Schoenfeld and many of their peers, a real staple in our organization, a culture carrier, and a personal friend of mine who lives about a mile up the road from me. So really excited to have Dan here. Colin, as I said, global head of discretionary macro and fixed income. He's been with Schoenfeld just under 2 years. They're a firm that I've gotten to know pretty well over the last few years. It's a great firm. They've done incredibly well. They've raised money for all the right reasons. They're good partners to the sell side, to their investors, and no secret to the success that they've had, the talent that they've recruited, and this macro product that they've built is a really important piece of the puzzle for them. So looking forward to having them on the stage. I'll turn it over to you, Dan, to come out, and thanks everyone for sticking around.
Thank you, sir.
Let's see. Great.
All right, let's do this.
Let's do it. Thank you, Lior, for the intro. And I would say, if you haven't met Bradley, his son, which I have and spent time with, he's a great kid, and it's a great cause coming from someone that also has experience firsthand with autism. So encourage you all to spend some time and maybe even contribute there as well. So on a less serious note, I'm super, super excited to be here today, to be on the stage and share it with you, Colin, on multiple levels. One is we've known each other for over 13 years. We were talking the other day. So it's been really incredible to watch your career flourish at multiple firms and what I think is kind of the last stop for you on the horizon. Why don't you walk us through, if you don't mind, and to contextualize, obviously you work at Schoenfeld. I've had the privilege to work with many clients through the years at multi-managers, at single managers, and the growth at Schoenfeld has been nothing short of meteoric over the last 5 years in particular. Walk us through and give us a little bit about your path to Schoenfeld, kind of how you ended up there, why you ended up there, and how it's going so far.
Yeah, first of all, it's great to be here with you. We're obviously close friends, but as you said, I think that you understand this business model exceptionally well. And I do think it's something that is kind of woven into my career path, because I would almost say that in today's age, it's a bit of a gold rush in terms of the popularity of the multi-PM platforms, some of the outperformance that they have had over the past few years. And in my case, I've just been really fortunate. I joined my first multi-strat, multi-PM fund as a lawyer 25 years ago. And since then, I have been a risk taker, a business head, and importantly, I feel like I've seen this entire evolution of the area from, when the days when it was hard to imagine that the multi-PM shops could be larger than maybe 4 or 5 billion in total AUM, and to see these $60 billion firms now. And it comes back to a question that I often get, and what is it that separates the the great from the good in terms of these platform shops now, what has made them successful. And I think these firms need to do a lot of things right. They need to have great technology, they need to great recruiting, they need to mentor talent, they need to be paranoid about risk management and exceptional on the risk management side. And I think what's really interesting is Schoenfeld is celebrating its 35th year anniversary this year, which that by itself I think is such an important milestone. But what's interesting is that there was this vintage in time. Within 18 months of Schoenfeld's launch, Millennium, Citadel also launched. Obviously, Balyasny was a firm that spun out of Schoenfeld. Exodus Point came out of Millennium. So, within that 18 months, there's this deep lineage of a large percentage of the assets in this space now. And I think it's important to remember, because I do think that there is a standing the test of time component to this, in learning from mistakes and continuing to improve these firms and evolve them. That's a really important part of the success of that group that I mentioned.
Yep, that's great. Maybe give us a little sense for the footprint of the macro business right now, where it stands geographically. And then also you mentioned in your comments, among other things, technology and infrastructure in terms of what's necessary to make a business really viable. Have to ask, kind of elephant in the room, any reluctance being a greenfield, starting a new business effectively foreign to a historically equity-only business? Any reluctance or concerns going in with technology, infrastructure, and how's that kind of gone heretofore?
I would say for me, it has become such a critical piece of this. You need great technology, great systems to be able to accommodate an assortment of strategies, which you need to have the right type of diversified profile at the business level. So it's critically important. And in my days at Citadel, which is where I was prior to Schoenfeld, obviously, Ken really considers Citadel a technology company now. And that was really beat into to me. Schoenfeld's history is that they were very early into the systematic quant-based equity strategies, which to me was really important because they have a very large technology side of the organization. They've done this well for 25 years, and having that type of resource pool to draw upon in order to launch my business was critically important. So today, to answer your first question, we have around 15 pods, 22 total risk takers. We have risk takers in Miami, New York, London, Los Angeles, soon to be Singapore. So very well diversified on a geographic basis, which I think is important as well, and also taking advantage of this footprint that Schoenfeld has across the globe already.
It dovetails nicely the geographic footprint with kind of recruiting and sourcing of talent. Obviously, it's been all over the press, in particular the last 2 years, how heated the recruiting process has been for risk takers. Talk a little bit, if you don't mind, given the surplus of capital and need for human capital, how have you been able to differentiate yourself, the Schoenfeld macro business, not only to have risk takers join you, but really partner with you and differentiate the value proposition and the career opportunity for them with you all?
Look, that recruiting side of the business is so critically important. In my case, I think it comes down to having a reputation for being a very fair leader, someone that takes an interest in the careers of the people that work for me. I think one of the benefits of launching a new business is being able to give other senior PMs a seat at the table so that they can feel that they can be impactful in the way that resources are being allocated and the types of projects and the way that the business will be shaped, as opposed to being the 6 of 7 teams that do the same thing. So it is very important. I would say, in terms of, I mentioned this gold rush in the multi-PM space right now, and they're so popular. I do think that something I worry about is, look, there is a finite amount of alpha to be harvested out there. And I think as more and more new entrants come into the market, I do worry that, to put it into kind of market terms, that a lot of shops are paying peak multiple for talent at kind of peak in markets, and should there be kind of a natural drawdown from here, that wouldn't surprise me. But clearly, from a recruiting perspective, it's a really important part of our business to identify a talent, to mentor a talent, and to retain a talent.
That's great. That's great. I think congratulations in order. If I'm not mistaken, you just kind of eclipsed, I think, 13 months since the launch of your fund. So once you're past a year, two great things happen. Everything you say is public, and we can audit all your projections. So it's a good opportunity for us to pivot a little bit to the investment side. Talk a little bit about share your approach on the macro side going to 2003. A lot of events have been happening, specifically kind of long short vol rates and even cash as an investable asset class for the first time in many years. How are you thinking about going into this year and thoughts broadly?
Yeah. Look, coming into this year, and this is what we take pride from our team's perspective. We like to be very pragmatic, very data-driven, to derive the most accurate snapshot of the world that we can. And a couple things just noteworthy, I would say. I'd say so far, if you think about the way the fourth quarter of last year played out, first quarter of this year so far, there have been two notable features that have driven a better mix of the inflation global growth dynamic. One was that China opened up much faster than people expected. And secondly is the fact that Europe had a much warmer winter than people expected. And both of those helped to alleviate and provide a tailwind for growth, because as you kind of look at the data set right now, look, global growth has surprised to the upside. Inflation is on a path down to, call it, 3 to 3.5%, which gives the Fed more room to maneuver at this stage. I think that where I would disagree with markets as they stand right now is it seems that there has almost been an extension of duration. And what I mean by that is, typically when the Fed embarks on a cutting cycle, you get these junk rallies. And if you see what's led the rally so far in January, it has been the crowded shorts, the underperformers from last year. So it is almost as if the Fed is actively cutting right now. And I think it's a bit early for that from my own perspective. I think the challenge is, as we look forward for this year here, are when and how much is global growth challenged? What do we see from a payrolls perspective in particular? And what is the market function reaction to that from the Fed? But I think that unfortunately the cuts that are priced right now are not likely to be realized. We're going to be in this restrictive neutral territory for a more prolonged period. So I think in some respects that the market has gotten a bit ahead of itself at this moment in time.
So that's a great kind of observatory summary of what the Fed's doing. I'd love your perspective. How do you think the Fed's doing? If you have to give them a grade, what kind of grade would you give them, and what are your concerns about the Fed's posture to date?
Look, I think Powell has to be really pleased by his own performance. He's navigated the most challenging inflation environment in 40 years. He's hiked above 4%, which people thought that would definitely cause the hard landing. In that process, he's obviously he's popped the most speculative points of excess leverage in the markets, but so far none of those things have had a more systemic types of consequence on the world. And if you think back to the end of last year, it was around the mini budget in the UK. You had the freak out in the gilt market. You had FTX surprising the markets 10 days later. You had the suspension of some of the real estate in terms of redemptions. I think people will end up looking at that as a bit of a low point in this moment in the cycle. And we got through that. So I do think now that the Powell and the Fed can focus on labor markets in particular and how much damage they end up doing to that side of the market. And I personally believe that there's been a bit of a policy shift in this. I think that QE and the types of wealth inequality that creates, I think that they don't want to hammer the wage inflation, the wage growth as much as maybe they would have in the past. So I do think that certainly not at this meeting, but in upcoming meetings, they will act a bit more gingerly on that, and will start to signal more of a pivot.
You bring up FTX. I don't want to go too far down the rabbit hole, but just as an aside, how much do you pay attention to what's going on in the crypto world as relates to your world? Are there any real correlations, or is it more a function of just observing kind of fund flows and liquidity constraints and the fallout?
Yeah, look, I would say among macro risk takers, everyone has been interested in that, because here you have this new currency that is promoted as having these risk-off characteristics, which we're always looking for that. I would say that we never traded those products, and I was probably a bit on the old guy stodgy side and a bit too skeptical, but I think in hindsight for good reason. But clearly you're always looking for that, because in any type of real market risk-off event, there is a pocket of excess speculation that ends up popping and spreading into other areas in a way that you get these unintended consequences. So we're always looking for that. And as I said, I think that in my 25 years and in Schoenfeld's 35 years, I think that what has allowed firms like this to stand the test of time is that paranoia around risk management and really understanding that. And in this business, you can make small mistakes, but you can't make big mistakes. And
you got to stay in the game.
Yeah, you always have to stay in the game, and that is what our risk frameworks are designed to do. I think that's the power of the model. I think that's why they're able to produce the unique return stream that they are. And I think all those things are important. Yep. And back to kind of the that side of things, I think one of the notable changes just from a markets perspective, and I think this week is a perfect example, because this week is kind of our Super Bowl, right? Yep. We have the Fed, ECB, BOE, payrolls. We had ECI, which is a really critical data point earlier today. And all of these things matter. I think for the first time that we've had that trilogy of central banks, the outcome is probably more known than it's been over the last 14 months, because look, the Fed's going to go 25, the ECB is going to go 50, the BOE is going to go 25. But the way that those hikes are delivered to the market in terms of the press conference, in terms of any forward guidance, I think is really critical for some of the unanswered questions in the market right now, which are really going to drive performance over the 3 to 6 month period. Because as I look where markets are right now, it's really probability weighting the path over that 3 to 6 months. And there continues to be a lot of uncertainty around that. So it's important that we get that right. And if you do, the opportunity set's going to be pretty robust for our types of strategies.
And would love to know, everyone thinks about these events like this week differently. You have obviously a ton of events you mentioned and data coming out. What's your posture and your team's posture this week? Is it to be more defensive or offensive, kind of reactive after the fact? And which of those kind of days and data sets, they're all relevant, as you said? Is there one that you're super focused on as part of your overall thesis and theme of how you all are investing?
I think this is a really good question, and something that I get the benefit of having this big pool of risk takers that report up to me, so we're able to measure this. And for example, this is something that we all do across our fundamental long-short equities businesses. You'll look at earnings season and look at your hit rates. How many of those earnings did your teams get right? What was their winning percentage? All of that. And really, for the first time in 6 or 7 years, that there's a very similar type of parallel across macro fixed income, where we can look at the major set of catalysts, whether that's central bank meetings, inflation prints, jobless claims, payrolls, and also ascribe a hit rate. Now, in in kind of back to the last decade in the very QE world where central banks had sucked all the volatility out of the markets, at every meeting you knew what the outcome was, months in advance. All of these events are live right now. And, for ourselves, our hit rate going into those types of events last year was, mid 70s. So look, it, like if you're a casino and you have a mid 70s hit rate, like
not
you have an
bad batting
amazing
average,
business.
yeah.
So I think that's an important driver of, the types of P&L opportunities that we saw across, rates and FX and which had been really dormant for a more extended period of time. So look, when you have a hit rate like that, you want to make sure you have the right type of risk going into those events to be able to maximize on the P&L side. But always think about that, and which of those events have you had the most edge in, and do you feel like you've had the best hit rates?
Yeah, not a bad time to launch a macro fund. I don't know if
I
you're
would say that
good or lucky or
I would say that timing definitely was a tailwind for us last year. So
Yeah.
I got that one right.
Yeah. Unlike our some of the crypto players that we kind of touched on a minute ago, you and I sadly are old enough to have some context for rate cycles historically. Maybe walk us through, is this rate cycle as aggressive as it's been kind of similar or different to other rate cycles, and are there parallels or things that you're learning as you go along in a historic context?
Yeah, I would say much different than anything we've seen, obviously, from the late 70s. And look, the biggest difference in this is this is a rate cycle that's been driven by monetary policy to curb inflation, right? First and foremost, really the last two and a half rate cycles that we saw were in large part caused by credit events. If you think about it, the 2020 episode with the pandemic, 2008. So you had these big events that caused the economic, data collapse, and then the Fed would embark on, providing liquidity to the markets, embarking on QE, the rate cuts. And I do think it's an important thing because, going back to my earlier point where I do feel like markets have overshot in kind of assuming that they're going to be able to extend duration because the neutral rate is going to drift lower here. I think that you have to remember that in a traditional business cycle, which we used to have, we kind of got away from that. But these lagged effects, they take some time to play out. And we all kind of live in the social media world. We want immediate satisfaction. But this type of economic slowdown takes time to play out. And look, one of the bigger risks to the markets is just that the Fed were to pause and then to have to resume hiking again because you did see a pickup in inflation. So
how much of a risk? Sorry, I didn't mean to cut you off. How concerned are you going back to the Fed's kind of grade? It sounds like you didn't give a letter. It felt like you were alluding to kind of an A-, B+. How worried are you about that happening? How real of a risk is that for the Fed to pause and then have to reflate?
Look, it is top of mind for Powell. He does not want to be the next Arthur Burns. It's very important for him. But some of this is just outside of his control, which is hard. It can depend on, the extension of a land war on the European continent. It can depend on semiconductors in Taiwan and our dependence on that. It can depend on an overheating of the China economy that drives inflation even higher, or just, look, services expenditures in the U.S. I think, the focus is on the services sector, which is where inflation is likely to come from. It's a more difficult thing to measure. And, if I had just one data series that I would say everyone should have on their Bloombergs and to be watching, it's services expenditures. So how much are people spending on services, and what is that going to mean going forward in 3 months' time, in 6 months' time? Because I think that will help to tell the story. So look, I think the Fed has done a good job, but again, there are a lot of these things that they simply can't control.
Do you have a view on duration, when that question will be answered? in terms of the Fed's conclusively? Is it you think this calendar year, obviously a function of data and how things normalize, but do you have a view when we'll have timing-wise, when we'll have a firm handle on the success of the Fed or not?
Yeah, I do. I think it's, but by the end of this calendar year, we will know. Look, I think the tails in terms of where we are from an interest rate hiking cycle are out of the market. If you remember 6 months ago when the Fed had the real hiccup with the hot CPI prints and was going to hike 25, no 50, no maybe 75. Things were becoming unanchored. They were becoming untethered at that moment in time, and that's not the case right now. Right now, absent an extraneous type of event, inflation is going to drift back down to that 3.5% range. And the question is how comfortable will Powell be at that level? And that really depends on payrolls and claims and services expenditures.
So before we run out of time, let's pivot to a few geographies. You alluded to and touched on China a little bit earlier.
Yep.
China has been and was central to kind of growth in the macro kind of world. Really since the 80s, I would say largely, when Hank Greenberg started going over with AIG and spending time and found a real growth engine. Are they as relevant as a growth engine today as they were 5 or 10 years ago? And how does the quick pivot, the quick shift in 6 weeks from a closed economy to a reopened economy change perhaps what you were thinking 6, 8, 10 weeks ago about China?
Well, I was on a panel probably 7 months ago, and at that time the question was, is China just uninvestable? Is this over? Look, China's going to grow above 5% this year. Think of the pent-up demand we had in the U.S. with a population of 330 million people. They have 1.4 billion people there.
Yep.
Think of the magnitude of the pent-up demand there and what that can do from an economic growth perspective. And look, a lot of Chinese equities are up 40%. And I do think that that's going to continue. So I think this is a tailwind that we haven't seen in this size, this magnitude in quite some time. And that's very influential on all the EMs that are part of the supply chain there and a filter through to the US dynamic as well. So I think that is a material change in global growth.
You mentioned uninvestable, which is a perfect segue into Russia, Ukraine. What's the setup for you now, both in kind of Russia, Ukraine, its effects? What are you watching to understand better how to express it? And how do you think about that in the mosaic, obviously, the European markets?
Yeah, look, we obviously have a series of military consultants that are expert on this, and we stay very focused on this. Look at the escalation that we've seen just over the last 10 days, turning this into what is, in my opinion, a true European ground war right now. That is a tale that I think is somewhat mispriced. I think people have become a bit complacent because we did get a warm weather in Europe, and some of the tales from a European energy nat gas perspective have been mitigated. But this is obviously one of the black swans in the market still.
And before we lose you, real quick, Latin America, a lot of moving parts there. Brazil, we have new presidencies, we have the Argentinian re-election on the horizon, we've got protests in Peru. How are you thinking about LATAM right now? Again, what's the setup and what are you kind of concerned about and maybe conversely bullish on?
Look, the Argentine bonds are up 12 points in the last week. So there is, the search for carry in using EM as a proxy for that, is clearly underway. Look, at the end of the day, I think that, just kind of the beta exposure of EM, is a short dollar trade. It's this easier financial conditions trade. So I think that there's a lot of ways to express this. But look, we're at a point where it should be a much better point in the cycle for much of EM.
That's great. How about a hand to everybody from the audience for a macro portfolio manager and business builder to be with us during such a busy week and economic data points. So we can give him a round of applause. And I'm sure he's around once we sneak out of the green room for questions one-on-one if you all feel like it. So thanks so much for being here today. Appreciate it.
Thanks, everyone.